Good morning. My name is Roni Dev Sharma from the Department of International Relations, Rajshahi University, and I am going to discuss about the monetary policy in 5 segments. What is monetary policy? Why do you need a monetary policy? Types of monetary policy, and tools of monetary policy, and objective of monetary policy. First, monetary policy. Monetary policy is the macroeconomic policy which is implemented by the central bank of a country to control overall money supply and promote economic growth and employ some strategies such as revising bank rates, changing bank reserve requirement. In Bangladesh, of course, it is implemented by the Bangladesh Bank. According to Bangladesh Bank, Bangladesh Bank's monetary policy is designed to support government policy and program in pursuit of fostering inclusive economic growth and poverty reduction while also maintaining price stability. Why do you need a monetary policy? We need monetary policy to ensure that there is economic stability, price stability, and a sustainable economic growth. Moving to the types of monetary policy, there are two types of monetary policy: expansionary monetary policy and contractionary monetary policy, depending on the level of growth and stagnation of the economy. Expansionary monetary policy. When is expansionary monetary policy implemented? During time of slowdown or recession, and expansionary monetary policy grows economic activity by lowering interest rate. Saving becomes less attractive. Consumer spending and borrowing increase because they will have more money. They will spend on productive activity and economic can thrive back. Contractionary monetary policy. It is opposite of the expansionary monetary policy. When there is too much inflation in the economy, the central bank increase interest rate and limit the outstanding money supply to decrease inflation by implementing contractionary monetary policy. We know that whenever too much inflation in the Bangladesh, the central bank increase interest rate. Goals of the monetary policy. Inflation. There are three basically goals. Inflation. Contractionary monetary policy is used to temper inflation and reduce the level of money circulating in the economy. Number 2, unemployment. An expansionary monetary policy decrease unemployment as higher monetary money supply and attractive interest rate stimulate business activities and expansion of job market. And thirdly, exchange rate. The exchange rate between domestic and foreign currencies can be affected by money supply. By monetary policy. With an increased money supply, the domestic currencies become cheaper than its exchange rate. And let's come to the tools of monetary policy. Basically, there are three major tools in monetary policy, namely, one, open market operation. In open market operation, central bank buy and sell the short-term bonds to investor to change the number of outstanding government security and money available to the country as whole. 2, the interest rate or discount rate. We know a central bank does not directly deal with the consumer or deal with the public, but deal with the commercial bank. The central bank change the interest rate to the commercial bank. A bank will loan more or less depending on in this interest rate. Thirdly, reserve requirements. Authority can manipulate reserve requirement, the deposit fund which commercial bank have to keep with the central bank as an emergency condition. Lowering these reserve requirements release more capital for the bank to offer loans or buy other assets. On the other hand, increase this requirement curtails bank lending and slow growth. Thank you.